Welcome back to Project Pulse. In the previous lesson, we built a total target debt service per period. So at this point, we know how much debt service the project can afford in each year based on our DCR targets. And in this lesson, we will convert that target debt service into an actual term loan size by bringing in interest rate assumptions. In other words, we will split the target debt service into interest and principal, and that's what ultimately tells us how much debt we can raise at financial close. And a key concept of this lesson is that we can size the loan by discounting the target debt service at the cost of debt in each period, which is a clean way to avoid a lot of circularity. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build a model alongside me. Link is in the video description below. Before we touch the model, here are the financing inputs that matter for this lesson. First, we have a debt margin of 2%. That's the bank's spread on top of the floating base rate. Second, we have a fixed swap rate of 3.9% and a swap margin of 0.1%, which results in a total swap rate of 4%. The swap rate is important because we have a 75% hedging requirement of our outstanding debt. And third, we can see that our floating base rate is SOFR, which we'll pull from the forward curve as a time-dependent input. So the big picture is that our margin plus base rate plus hedge structure gives us the interest rate we will discount with. But first, let's understand why swaps even exist. In project finance, lenders want stable and predictable debt service. A swap helps reduce the risk of floating rates moving against us. Mechanically, a swap is just an exchange of cash flows on a notional amount. The most common structure here is fixed for floating. We pay a fixed rate and receive a floating reference rate. And in project finance, this is often not optional. You will typically see a minimum hedging requirement. And in this case study, we assume 75% of outstanding debt is hedged. Now, before we jump into the model, one quick reminder. SOFR is the benchmark floating rate. It reflects the market's expectation of short-term funding conditions over time. And in our model, we don't guess it, we pull it from a forward curve. Now let's move back to the checkpoint file from our previous lesson. Up here under our macroeconomic assumptions, you will see our SOFR forward curve assumption. SOFR is time dependent, so instead of one flat assumption, we use a forward curve. This essentially gives us a different base rate in each year, which means that the cost of debt changes over time. And that matters because we're going to discount each period's target debt service using the interest rate in that same period. Alright, now let's implement it. And the first thing we will have to do in this lesson is pulling in our different interest rate assumptions, before we can use those interest rate assumptions to then discount our total target debt service at the cost of debt in each period to ultimately arrive at our final term loan size. So let's start by pulling in our SOFR forward curve in row 532. And we'll do this with using an XLOOKUP. So type XLOOKUP. Our lookup value is going to be the calendar year. So select K4, hit F4 1, 2 times, comma, our lookup array is in our inputs time dependent sheet. And the SOFR curve is our first macroeconomic assumption. So let's select row 11 from column L up to AT, hit F4 once to fully anchor this, comma, and for this lookup we will select row 12. So make sure that you're not using the applied SOFR forward curve after our sensitivity. For this one we will want the SOFR curve before sensitivity. So select L12 to AT12, hit F4 1, 2 times, comma, 0 if not found, and match mode is exact. So again 0, close parentheses, hit enter. And then hit F2, we will also multiply this with our term loan tenor flag. So multiply it with row 517, hit F4 1, 2 times and enter. And the reason why we're not using the SOFR curve including any sensitivity is because this interest rate here is only for sizing purposes. So for sizing purposes, we do not want to sensitize our base rate assumption. But once the debt amount has been sized, then we want to see how an increase or decrease might affect our overall debt service coverage ratios in each period. So it's important that we differentiate here between the SOFR we pick up. Drag this over, Control R, and we get an error here. And we can ignore that for now. Let's just double check. Let's see, 2031 is 4.54%. And that's actually not the case. So let's double check our formula. Hit F2. And yes, actually we got the anchoring wrong. So of course we want to make sure that we fully anchor the return array. So let's make sure that you fully anchor this reference here and here. Hit enter, and then let's drag it over again, Control R. Now we don't get an error, and let's double check again. 2032 is 4.13, which we get right here in column R. So that seems to work properly now. Then the fixed swap rate is fairly straightforward. That is basically just a reference to our fixed swap rate in G533. Hit F4 once to fully anchor it, and we'll also multiply this with our term loan tenor flag. Let's drag this over, Control R, and that essentially tells us what our fixed swap rate or our fixed hedge rate will be for the hedged portion of the loan, and our floating base rate is essentially the cost of debt we will have on our floating component or unhedged component. So that allows us to model our blended base rate before including any margins. And that is going to be equal to, let's do an if statement. And we will say that if our term loan tenor, which we'll use for sizing purposes and which will be our hedged tenor essentially, hit F1 2 times. If that equals to 1, then we want a blended rate, and otherwise we just want a floating rate, because outside of our term loan sizing tenor, we will not have a swap in place. The swap will only be in place for the actual term loan tenor. So first we pick up our hedging ratio of 75%, hit F4 once, and the 75% we'll multiply with our swap rate, which is the hedged rate, so row 533. Plus, that gives us 75%, and then open parentheses, 1 minus our hedging ratio. So 1 minus 75% is 25%, hit F4 once, close parentheses, and this will multiply with our floating base rate or unhedged SOFR rate. So K532, comma, and if the flag is not on, which means we are outside of our debt tenor, then we just want to pick up our unhedged floating rate in K532. Close parentheses, hit enter. Let's drag this over, Control R. And you can see in the first period we get 3.88%, which is kind of like what we would expect, because 3.88% is closer to 4% than 3.5%, and that is because we have a hedging ratio of 75%. So 3/4 of the outstanding loan amount are hedged, while here in the first year we only take a partial upside in the floating rate that is expected to be slightly lower than our fixed swap rate. Then we can calculate our all-in interest rate, and that is going to be equal to, open parentheses, our margin of 2%, hit F4 once, plus our blended base rate in K534, close parentheses, and we'll multiply this with, open parentheses, 1 minus, let's scroll up, our financial close. So if it's our financial close, select K11, hit F4 1, 2 times, close parentheses. If it's our financial close, then we do not want to calculate an all-in interest expense because we expect that the financial close is at the end of the period, which would be in our case the 31st of December 2025, which means we do not owe any interest at the financial close itself because the term loan balance hasn't been sitting in our balance sheet for the full period. It was just drawn at the end of that same period. That's the reasoning behind excluding it for the financial close period. And then we'll also multiply this with, let's scroll back down, our term loan tenor flag, because the margin is only due during our actual term loan tenor. Hit F4 1, 2 times and hit enter. Drag this over, Control R. So that gives us our all-in interest rate for sizing purposes, which is between 5.8 and roughly 6.1 or 2%. And then we'll also implement an applied interest rate, including our base rate sensitivity. Our base rate sensitivity is either a lift or a decrease of our unhedged SOFR rate. So let's hop into row 538. And that is going to be equal to our unhedged SOFR rate in 532 plus our SOFR uplift in G538. Hit F4 once, hit enter, and that is coming from our inputs time independent sheet. And you can see that, for instance, in case 3, we will have a SOFR shock. So let's turn on case 3 for now. And then you will see that here we have a uplift of 5%. Then let's drag this over, Control R. And actually we can also multiply this with our term loan tenor. So let's multiply this with 517. Hit F4 1, 2 times, drag it over again. Then for the fixed swap rate, let's pick up the formula that we had right here. But before we do this, let's anchor this to our row. So anchor 517 to the row only, drag it over, Control R. And then we can copy this formula, paste it here, hit F2, the reference is right. And then let's also pick up our blended base rate formula right here, hit Control C, Control V, F2. And here the references seem also to have been picked up properly. And then we should be able to do the same for our all-in interest rate. Copy this, paste it here, F2. And here the reference also seems to be correct. Drag all of this over, Control R. And you can see we have a significant uplift in our all-in interest rate, but not by actually 5%, but by significantly less. And this is actually an increase of, it should be 1.25%. Let's double check this. And why is it 1.25%? That is because we have 75% hedging ratio, which means that if our floating rate increases by 5%, the SPV will only feel that effect on 25% of the outstanding notional. So that's the beauty of hedging. If interest rates were to run away, 75% of our total debt notional would be protected by our swap. So let's delete this one for now. And now comes a key concept for this lesson. We want to find the loan amount that can be supported by our target debt service schedule. Our target debt service schedule we have determined in our previous lesson in row 522. So we know our total target debt service in each respective period. And what we don't know is the split between principal and interest in each period. And to determine the ultimate term loan amount, we treat each year's target debt service like a cash available to repay debt. And what we will do in each respective period is discount each period back to financial close at the cost of debt in that specific period. So this total target debt service here will be discounted at the cost of debt in the respective period. And what we will essentially do is build a discount factor multiple from the interest rate, and from that we compute the PV discount factor right underneath. And once we have the PV discount factor, we can calculate the NPV of target debt service, which is the present value of the debt service capacity. And that effectively is the maximum debt the project can support under a sculpted schedule. And before we implement it, I want you to understand that this is a really powerful technique because it converts a debt sculpting problem into a clean present value calculation. And that ultimately reduces the circularity within our model and keeps the sizing step very transparent. But first things first, we'll start with our discount factor multiple, and that is going to be equal to our previous period value, where we have a technical input of 1 right here, times, open parentheses, 1 plus our all-in interest rate before our base rate sensitivity in that specific period. So 1 plus 0 will still be 1, and in the next period we will have 5.8% and so forth. Close parentheses, and we'll multiply this by 2 different flags with a max function. So we want this to be the maximum of either we want financial close to occur, which is going to be the first period, so we don't want to lose our value 1. Hit F1 2 times to make sure that we are not losing our 1, comma, and then we'll also multiply this with our term loan tenor. Flag in 517, hit F1 2 times. Close parentheses, hit enter, and let's drag this over, Control R. And now we have a discount factor multiple for each period up until our debt sizing period or term loan tenor is over. And if you wouldn't have multiplied with our financial close flag, let's take this out for a moment, you will see that we would have lost our discount factor multiple. So hit Control Z to make sure that we are also multiplying with our financial close flag. And this essentially is just like an index. So if inflation is, for instance, 2%, you can see that in our indexation, our CPI, for instance, also goes up from 1.0 up to 1.3 a few years later. It's the same principle here for our debt. And that we are able to actually determine the present value of our total target debt service. What we'll have to do is basically just compute the 1 over this discount factor multiple. And since we might divide by 0, let's do an if error statement. So if error, open a second parenthesis, 1 over our discount factor multiple, close parentheses. If that's an error, it's a 0, close parentheses, and let's multiply this with our term loan tenor flag as well. Hit F1 2 times, and let's drag this over, Control R. And now we can calculate the NPV from financial close perspective of our target debt service in each respective period using our PV discount factor. And that is simply going to be equal to our total target debt service. And right here, watch out, we are going to use row 524, which is our total target debt service excluding any LC interest. So it's important for us to use our total target debt service after we have paid LC interest, which we'll model in a future lesson, but make sure that the linkage here is right. So 524 times the PV discount factor in row 544. Hit enter, drag this over, Control R. And when we sum those NPVs across the tenor, resulting in $76.8 million, we get the present value of the debt service capacity, which is effectively the maximum debt the project can support using our sculpting method and our contracted 1.3 DSCR as well as our uncontracted 2.0 DSCR. And this leads us to our final term loan size of 76.8 million after considering two different debt sizing constraints. The first one is our DCR target sculpting, which we did in row 545. And the second constraint is our max term loan according to our leverage ratio. And that is equal to 80% times our total capex excluding financing fees. So in our information memorandum, we are also given for different cases different maximum leverage assumptions, which is case dependent. And the more contractor cash flows we have, the more debt lenders might be willing to provide on a leverage ratio basis. And here in case 3, for instance, we have 80%. And if we were to flip to, say, case 12, let's see what happens. In case 12, we are restricted by 40%. And here you can see that our NPV of target debt service would allow for 59.6 million. But our final term loan size is the minimum of those two numbers. So here we take the minimum, which is in line with 40% of capex. We can also hit our macro. And you can see that once we actually copy and paste our hard codes, our debt profile will have changed. And our NPV of target debt service will be much lower. And again, the restricting factor, unlike the maximum leverage ratio. So that's good practice to understand how the macro works. And if you have hard codes in your model, you always want to make sure that these hard codes are actually reflecting the actual calculatory body of the live case to avoid any accidental mistakes. Alright guys, that completes the sizing logic. We used interest rates that translate target debt service into a bankable term loan amount. And in the next lesson, we will implement the term loan account, calculate principal repayments per period, and then compute term loan interest based on the outstanding balance. Alright guys, this was it for this lesson, and I will see you in the next lesson. See you there.